Are you curious how Trump's one big beautiful bill could reshape the real estate landscape? Join me as I sit down with attorney Brent Nelson to break down the key provisions and what they mean for the real estate industry.
Good morning, everybody. Almost not morning for our East Coast friends, but since Eric and I live on the left coast, which is the correct coast, we do this our time. Thank you, everybody, for joining us. Eric Freeman is my guest today. Eric, I'll let you introduce yourself, but if you don't say something that I find interesting about you, then I may chime in, but go ahead.
Well, that concerns me a little bit, but thanks for having me, though. I'm a CPA. I focus on real estate taxation, work with a lot of developers, property owners, syndicators. Been practicing for about 15 years. I'm a partner at Beach Fleischman PLC, and we are I think we're the 126th largest firm in the US, which, just to give a little context, is there's approximately 44,000 firms, and that includes sole practitioners all around the US. We rank 126 out of that based on revenues. And here's the interesting thing. I'm going to do a little plug.
All right.
If you haven't seen it, I just finished a book a year ago, Tax Strategies for Everyone. Still relevant with the new tax law, yes, because there wasn't a lot of changes, but it covers everything. If you don't know anything about taxes, it helps. If you think you're an expert, I guarantee you there's something you're going to learn, and it's everything from starting a business all the way to the exit and estate planning. So I think it will be helpful for anyone.
Yeah. And now you've committed yourself to a lifetime of new additions. Eric, that's what's
Exactly.
happened.
I think the second one is underway already.
Well, you knew what you were getting into, and that's what's most important.
Exactly. It's fun. It forces you to actually know what you're talking about.
Yeah, I think writing is the best way to learn yourself a topic because you really have to think through how do you communicate this? What words do you use? Do you have the information correct? And oftentimes when I'm writing, it's like very start stop because I'll think in my mind that I know how to say it, but then as soon as I try to say it, I learn that that is not the correct way to say it. And there was something I wasn't thinking about. And then I have to go back and reinvent the wheel.
Exactly. And then if you have other people read it and they tell you their interpretation is, and you realize, okay, I need to clean this up a little
Right.
bit. That's not clear. And I mean, because you're trying to, anytime you're writing, especially about tax or law, you're trying to simplify very complex topics and not be a code head the whole time, depending on who it's for.
Yeah, exactly. Depending on the audience. Although my belief is this could be inaccurate. So when I say this, if you disagree, please
I'll jump on it.
freely do so. But my theory is that even people who are really into the technical details, the exceptions to the exceptions, even for those people, you have to figure out how to communicate in a clear way that isn't so jargon heavy that it just becomes a soup that is unedible. And that's not easy.
I agree. And you're totally right. Even when you're talking professional to professional, obviously if there's some type of disagreement or teaching on one part, having references is great, but the code, none of it is written in language that normal people should be able to understand. And in fact, when you read it, there's so many provisions that there are multiple interpretations, and that's why we end up with, you know, gray or loopholes a lot of time. And that's also why the IRS and Treasury have to come out and try and correct it through other means, which sometimes is still unclear. So you have to kind of dumb it down.
Very true. Well, for our audience today who are not dummies, but we're going to try to communicate this as clearly as possible, we're going to talk about the real estate specific provisions in the One Big Beautiful Bill Act, or HR1, or whatever it is that people call this thing. I don't really even know what the name is, because I think from my perspective, there were some changes, maybe not earth shattering in the sense of brand new, like we kind of got with the Tax Cuts and Jobs Act. but changes nonetheless that people need to be aware of, at least from my perspective. So I'm curious to hear your thoughts on what do you think are the highlights for people in the real estate industry?
Well, I'll start off setting up the scene. So we all know that Trump enacted a lot of new tax law changes, like you said, with the 2017 Tax Cuts and Jobs Act. And most of those provisions, or a lot of those provisions, were set to sunset or were changing over time. We already saw some of the provisions changing in the last couple of years, but the end of 2025 and the end of 2026 were going to be big sunset years where things were going to go away. And by go away, I mean, in most cases, taxes for the majority would be increasing, because in his first tax law that he passed, he lowered tax rates. So those would have gone up. We would have seen the estate exemption lowered substantially. We would have seen certain deductions like the 20% pass through deduction, or the technical term qualified business income deduction, go away. So there were a lot of things on the line. So what this new bill did, it really wasn't a surprise that he was trying to pass this and campaigning on it. Basically, passed these laws in his first term. So this was really more about clarity and having consistency, and something where we actually knew what the tax laws were going to be. Because ever since he passed it, we didn't know what the tax laws were going to be after 2026 for sure. We didn't know if they would be renewed or not. So this allows for us to do some planning. So first, I would say that a lot of big items that have been targeted are safe for now. So like 1031 exchanges always comes up. There's big talk, especially during Biden's administration, about limiting the amount of property you could do in a 1031. I think it was $1 million. I don't remember. It doesn't matter because it didn't pass. But it would have had a huge effect on the real estate industry, limiting that. There was talk about doing away with the home sale exclusion. So that's the when you sell your personal residence, you can exclude up to 500,000 if you're married filing joint. That's safe. Another big one that is targeted even during Trump's first term was the carried interest provisions for real estate. That's safe for now. So as of now, for the most part, real property, if you have a carried interest in a partnership, that essentially means you're getting some sort of profit interest without putting in capital. You're doing services, and most of the time that's taxed at capital gain. If you hold that interest for more than a year for real estate, that's safe for now. There's different rules if we're talking about assets other than real estate and partnerships. So that's definitely not a blanket statement. That's real estate specifically. And then, as I mentioned, we had the 20% pass through deduction, which is effectively for partnerships and S corporations. It reduces the tax rate if you qualify for it to be on par with the reduction in the corporate tax rate that we had back in Trump's first term. So all of that was preserved, which is good. And some of that, like the 20% pass through, was set to expire. So getting an extension on that was definitely a win for real estate, because most real estate is going to qualify for that 20% pass through deduction.
It's interesting you mention the things that were on the hit list of the Biden administration, and then things that were in essence on the hit list under the Tax Cuts and Jobs Act, which were all of the individual provisions that were temporary, set to sunset in 2026, because it's a real good indicator for everybody hearing what you're describing to remember that in the tax law, everything is as permanent as the next administration wants to make it permanent. And so even having some clarity is nice. And I totally agree with you. I think a lot of the extensions, for what it's worth, it's not a surprise that they extended it. They were talking about extending these back in 2018, 19, and they wanted to make them permanent almost immediately once they passed them and had a sunset on it. It was more a question of the cost. But the idea of having that sort of clarity gets you through a 3-year federal cycle, and then after that, we'll see. And every single administration then dredges up almost the same list of topics, although the qualified business income deduction was new under the Tax Cuts and Jobs Act. The idea of changing tax rates as between, say, pass-through businesses and C corporations is not new. And so I don't think it's the last that we're going to hear on these topics.
No, definitely not. I remember when I was in college and, the master's program and everything. So this would have been 2011 at that time. And at that time, carried interest was being talked about, and it had been talked about for over 10 years before that.
Right.
So, I mean, it's luckily, I guess the real estate industry has good lobbyists because most of the time they end up winning. Us accountants and lawyers end up on the losing end.
Yeah, it's usually true. No tax benefits for accountants and lawyers. How is that possible? All the lawyers are the lobbyists. But the other thing about that, you talk about the carried interest. In my mind, and I'm theorizing here because I don't have any sort of inside knowledge on this. I'm just trying to put pieces together. But on the carried interest side, Trump has talked about getting rid of the capital gains treatment for carried interest for a while. But I wonder if, obviously between the real estate industry and Wall Street, if the pressure coming on him and his administration has been something along the lines of, look, you want us to do these opportunity zone projects, you can't then take away carried interest. Like, you have to incentivize the developers and the fund managers to put together the exact projects that you're trying to get us to do in these opportunity zones. So you can have one or the other, but you can't have both. I can only imagine that conversation happening. I don't think it's wrong. I think that's reality. And interestingly, they didn't do anything to carried interest, even though they talked about it, and extended the opportunity zone program permanently, quote unquote, permanently.
Quote unquote permanently. We will see. But that was another big win. And as you noted, what's interesting about, I'll back up just for anyone as a refresher on opportunity zones. This was new with Trump's Tax Cuts and Jobs Act. And it basically allows you to take a gain from the sale of any capital asset. So it's a business, it's stock, it's real estate, and you can take that gain and invest it in these designated zones, which were designated on a state by state basis. All the governors were involved in picking these tracks that qualified. And you did it through what's called an qualified opportunity zone fund. And you were able to defer that gain up until 2026 if you held on to the assets. All of that is coming due for anyone who deferred gains under the first program. And if you held it for 10 years, you would exclude all the appreciation and the investment within that opportunity zone. That was set to sunset at the end of 2026. Of course, any existing funds would be allowed to continue holding and get their 10-year hold, but you couldn't have any new qualified opportunity zone funds after that date. So now we have OpZone 2.0, as people call it, and they've changed some things on it. For one, there's going to be new designations. The tracks probably aren't going to be as nice as the last one. So under OpZone 1.0, there would be certain qualifications based on income levels and certain tracks would qualify. But a lot of that data was years old. So there could have been an area that was doing well and was above those income levels, but because they were looking at old data, it ended up qualifying. On top of that, they were allowed to pick a certain number of tracks that were connected to the tracks that qualified based on income levels. So you ended up with nice areas sometimes just because they were next to an area that needed some refreshing, we'll say. If anyone's familiar with the Phoenix area and Old Town Scottsdale, really nice area, that's an op zone. I doubt it's going to qualify going into, OpZone 2.0. So basically the new one, it's very similar, but there's some changes. You're able to defer the gain that you invest in these zones for 5 years. So it's kind of like a rolling 5-year, unlike the previous program where all the gains became due at the end of 2026. And then you have a 10-year hold before you can exclude the appreciation on those investments still. I think you can't hold them more than 30 years, if I remember. So there is a cap on how much appreciation you can capture. They did add a benefit for rural tracks. So if you invest in a rural track, that gain that you're deferring into the zone that comes due after 5 years, you can exclude 30% of that gain and never pay tax on it. For any other track, it's 10%. So I think we'll see how that goes. I mean, my own little anecdote on op zones. One, I love them because I do a lot of work with them and my clients use them. So I'm only going to be positive. But I will say that every project I've seen and worked on, it felt like those projects were going to happen regardless of the op zone benefits. Because while it does increase your after tax return substantially, real estate projects are tough to pencil in general. And we've seen that in the last 5 years, especially since COVID. In fact, you saw a lot of these projects abandoned because construction costs simply went too high. I think it's hard to come up with the data to see if these actually have the intended result or not. So we'll see how it goes. I think it's probably too short of a time period. When it was first enacted in 2018, we didn't even know the census tracts, I think, until like July or something of that year. So you didn't know that. And then we didn't have rules on how it worked until the end of 2019 that clarified all the nuances. And then we had some unusual market situations. I think it's too early of a time period to see how much of a benefit it actually had. So I think it's good to see this extended and see maybe there'll be better data going forward on what kind of effect this actually has.
I think it's a program aimed at the real estate industry, primarily developers, and raising property values in areas that have or maybe are viewed as having depressed property values. So it's a net win to that group of people. It's a net win sometimes to counties and cities who are collecting the property taxes. There's nothing in the program that suggests that it's supposed to be there to benefit actual people who live in those places. Maybe it's to the benefit of people who move into those places in the new projects. I don't think I saw any opportunity zone projects that were created from scratch just because of the program. It was projects they wanted to do anyways, but because of the opportunity zone project, the pro forma looked better. And
Yes.
so it was an easier sell to investors.
Yes, that's the thing. And you were talking about the carried interest from a developer standpoint, a sponsor standpoint, if they're not putting any money in, because and sometimes they will put their own money in, but you don't get any benefits if you're not investing capital gains. And a lot of people miss
Right.
that. It's not just that they're not investing, a lot of times they're not investing capital gains, maybe. So the developer most of the time isn't actually getting a benefit from the op zone. So really it ends up being marketing for their project where it's, hey, you could invest in the same project with someone else, but theirs is in an op zone. So you're
Right.
going to get a 40% boost to your after tax return simply because you're not paying tax on the appreciation. That's how it's been sold to investors, which isn't wrong. You just have to still look at all the normal factors.
Right. Exactly. It still has to be a real estate project that makes sense. After a certain number of years, 10 years under the prior program, 5 years under this program, you do have to pay tax. And 5 years feels very private equity to me, like projects that they think they're going to do and then flip within that 5 year period. So they'll have their cash and maybe they'll pay their capital gains or roll it into some other program. The 5 year number feels very meted out for normal kind of private equity life cycles. But we'll see.
One other thing I wanted before we move on is on op zones, a really critical thing to understand that will boost the returns even more if you have these projects is taking depreciation deductions. Normally, you have to recapture all of that depreciation when you sell an asset. In an op zone, you don't recapture any of the depreciation. It's considered all gain forgiveness and excluded from your income. The strategy there is doing things like cost segregation studies, which essentially you get an engineer goes on the property, breaks out the different components of the real estate and accelerates the depreciation. You break it down into assets that are like 5 year, 15-year components instead of the typical 27 and a half for residential real estate and 39 years for commercial real estate. So that is basically like double dipping because you get the benefit. And then if you sell it right at 10 years and you've accelerated all those deductions, then you're not picking up any of that gain, which also kind of brings me to the other provision that
Mm.
everyone in real estate was super excited about, which
The
was
provision.
the provision. Everyone was looking out for this, but that's bonus depreciation. It was increased back to 100% bonus. It was going to be 40% in 2025. So I've already seen a lot of developers and sponsors kind of looking at that as another way to market to investors. Hey, you're going to be able to write off X percentage of your investment in the first year simply because we can do a costing study and take 100% bonus. There's also certain assets that qualify for 100% bonus that otherwise wouldn't. Like, everyone talks about gas stations, car washes. They added a new asset, which is qualified production property, essentially non-residential property that's used in a qualifying production activity, usually like manufacturing and refining of products. The only negative is I don't think real estate investors can take advantage. I think you have to be an actual owner and operator in that industry, but
Mm.
I could be wrong about that.
Another thing that people in the industry who are on the development side or the fund management side, they're going to be sure to put that in the brochure for potential investors. My experience with large institutions, you talk about companies that create products or refine products, many times they don't own their own real estate. So they're relying on other companies to build and maintain and manage the real estate for them, and they just use it. So that's where the investor dollars are coming in to build real estate that's ultimately going to be leased to the end user and then have a portfolio of those. So we'll see. I think that's an interesting development. It feels very deja vu on the bonus depreciation side. It's one of those things where 100% bonus depreciation, like new market tax credit, just comes back and then it goes away and then it comes back again. It really depends on who's in the White House, probably because it's very lucrative for people who invest in real estate, makes it a very tasty treat to throw on the table for certain policymakers.
Yeah. And it's now has a long history because I think it was first enacted in 2001. It's been around for over 20 years. Since then, it has gone through a lot of iterations. I don't think it's ever been gone for any tax year, but it's been as low as 20%, if I remember correctly, and as high as 100%. It just keeps going up and down. It's one of those things that makes tax planning really hard sometimes. This year, for instance, we are at the end of 2024 looking at, maybe there's properties under contract or whatever the case may be that are closing in early 25. And so you're guessing, am I going to get 100% bonus? Am I going to get 40%? We didn't know for sure until July 4th for this year. And then you end up with things that you also don't quite expect sometimes. One of those things in the case of bonus depreciation that catches a lot of people is this requirement that it's not only placed in service after January 19th, which is when the 100% bonus begins, but it also has to be an asset acquired after January 19th. So some projects that started in 2024 that were maybe coming online in 2025 after that January 19th date, especially construction projects, because those have a long time horizon, those may not all qualify for 100% because you actually had the property previous. And there's different rules depending on if it's purchased or constructed property. If it's purchased property, you have the binding contract rules, which basically say if you had a binding contract previous to this January 19th date, then you were treated as acquiring it before that, and you'd be stuck with 40% bonus, even if you put it into service in February. Looking at whether you actually had a binding contract or not is critical. There's some exceptions to it. If you didn't have a big deposit or if it wasn't legally binding, you have to look at it on a case by case basis. Constructed property has its own rules, which basically say if you began a substantial amount of the improvements prior to that date, and they define that as 10%. So if you have a project and you've done 10% of the work prior to January 19th, then by default, it's going to be stuck in 40% land, not 100% land. there is an election for that to basically almost like a cost seg, but not quite. But you basically look at the different components of when it was built or paid for. If you only laid the foundation before January 19th, that would be stuck in 40%, but it probably doesn't qualify for bonus anyway. So this year, it's going to be really critical kind of looking at that when people are doing planning, because I know I have a lot of clients that are, straddling that line with and every circumstance is different. So definitely something to consider for this year. And then hopefully going into future years, it won't matter so much.
So if you have someone who comes to you and says, we're going to start a new project, what are the sorts of things that you're telling them to do and not do?
Well, I think if they have not started construction before that date, even if they knew they were going to do the project and had a contractor, that doesn't matter. It's the actual work getting done. So I think if you're after that date, I don't think you have an issue. You're going to qualify for 100% bonus as long as it's placed in service while we still have this 100% bonus rule. I do think it becomes even more beneficial now to do cost seg studies. I mean, the time value of your money now on those studies for constructed or purchased property is significantly higher. I just did some numbers for a client. This was a hotel, so they generally get higher breakouts and benefits on cost segs because there tends to be a lot of personal property. It was something like, based on the amount of leverage they were looking at, 80% of their investment. So if someone puts in $100,000, 80,000 would be their deduction just from the cost seg. Normally, if you're depreciating it over the full life, I mean, it just depends on the numbers, but I mean, you're not going to get anywhere close to that. So that's a huge boost. And I think that's also a sell for raising capital. If someone has gains, they just sold something, they need to offset somewhere else, then telling them, hey, if you invest that here, you're going to write off 80% of it. That's a big deal.
Are you telling a lot of clients that would be starting projects or contemplating starting projects that they just need to be prepared to do cost seg studies, like, because the
Yeah,
numbers are so compelling?
yeah, and I guess the only potential time that I really think of where it doesn't make sense is if you're placing it in service and it's immediately leased, and then you're selling it right away. Because in that case, if it's not an op zone, you're probably recapturing a significant amount of it. Now, if you're holding it for a few years, and depending on the asset class, it probably still makes sense, depending on the dollars, to still do a cost seg, even if you plan to sell. It has to do with how the sales price gets allocated to assets. So if you're looking at things like an apartment complex, a lot of the things that get broken out as shorter life and are eligible for bonus are things like refrigerators, carpeting, cabinets, and blinds, things you're probably replacing a lot anyway. If you're holding it for a few years, just kind of to illustrate, let's say you have $1,000 refrigerator, and you've got 200 of them in this apartment complex. So it's, time X 200, but you've got $1,000 refrigerator. So that's included in your cost set. You write off the entire amount of this refrigerator. Now your basis is zero. If you go to sell in 3 years, that refrigerator is not worth $1,000, right? It's a used refrigerator, and the buyer's buying structure improvements and leases. So maybe the refrigerator is worth $200. So when you recapture the depreciation, you're only recapturing 200 at a higher rate, not 1,000 at a higher rate. If you didn't do the cost seg to know the breakout, then you're recapturing all the depreciation you took on those items. There becomes this spread where you can take advantage of the rate difference by getting an ordinary deduction for the depreciation, and then picking up capital gain on the sale, which right now, depending on your individual factors, might be a 15% spread in rates. So you have a big enough dollar, still makes sense to break it out.
Right. Makes sense. Very interesting times. Well, we will see what happens in the industry. I know it's also an industry that's very sensitive to interest rates and lending, and that's up in the air at the moment. We will be wiser in the future. We'll look back at this conversation in 5 years and think, such babies, we knew nothing. How we've grown.
We just don't have to look at the conversation and we'll never think that.
Even better. Well, Eric, I really appreciate your time this morning and expertise.